Good evening, everyone, and welcome to this webinar on financial services. Hopefully, it will examine some topical questions about where we might be heading in financial services regulation in the near future. We will seek to answer some questions at the end. So if you have any questions, do send them to us using the Q&A button at the bottom of the screen. It's my pleasure to introduce our speakers this evening. They're all extremely knowledgeable in this area, and I start with Sarah Cody, who is counsel at Linklater's financial regulation team, specializing in UK contentious regulatory work. She has experience of all aspects of regulatory enforcement work and has written extensively on both FCA and PRA enforcement decisions and global enforcement trends, and has developed a particular expertise in the FCA's new consumer duty. Next is Hannah Meakin, who is a financial services regulation lawyer at Norton Rose. She has a particular focus on market infrastructure, commodities derivatives, and fintech, and has particular experience in brokerage, exchange trading, clearing, settlement, the list goes on, don't worry, custody, client money, and wholesale conduct. Don't know how she manages to do all of that. No doubt she can explain that to us later. Hannah also chairs the City of London Regulatory Law Committee. Simon Morris has been a partner in CMS's financial markets team since 1988, having joined the firm in 1980. He advises a wide range of UK and overseas financial institutions on regulatory matters, including in relation to market conduct, systems and controls, governance, and responding to regulatory concerns. And last but not least, we have Rob Dedman, who is a partner in the financial services practice, again at CMS, specializing in contentious regulation. He was on the other side for 10 years, a regulator, serving as the PRA's first head of enforcement, during which time he led the PRA's first enforcement cases. And Rob now advises clients on the other side across the financial sector on their engagement with the regulators. So I'm sure you'll agree we have some very knowledgeable speakers this evening. And without further ado, I'm going to kick off with the first topic, which is to do with the Edinburgh Reforms and early views of it. What has changed and what should change? And I'll first turn, I think, to Simon and ask, Simon, the Edinburgh Reforms were, I think, touted as a real shift in UK regulation. Can you first please tell us what the main points of the reforms are, and then what's your view as to whether the reality has measured up to the hype, and what perhaps could have been done better, Simon?
Well, ladies and gentlemen, good evening. It's difficult to answer the Edinburgh Reforms because, first of all, they don't really exist, and secondly, they haven't yet actually happened. But parking that for a minute, the Edinburgh Reforms are a package. They were 22 measures, cobbled is a fairly rude word, together. They were called a bold collection of reforms. I think it is really an attempt to show a benefit of Brexit. They're a bit of a ragbag, and they basically happened because of Brexit. And there are really three key changes. The first, most obvious one is if we're no longer to be a member of the EU, all applicable EU, which has been put in the deep freeze and applied as retained EU law, has got to be made basically UK law. And this is an inevitable change, because as UK financial services develops, so too will UK regulation. And now we're no longer going in lockstep with the EU. It is going to be done very slightly differently in the UK. And this is an inevitable consequence of no longer being members of the EU. The second change is the government will start to be slightly more political towards the regulators, because before so much was simply being done by directive and by regulation. Regulations, of course, were absolutely immediately applicable. And so the government is putting in slightly different wording, what is called the annual remit letters, which are the permitted directions from the Chancellor to the two regulators. And there is now a secondary objective of growth and international competitiveness. And goodness me, the PRA welcomed it. Sam Wood said, we welcome, we embrace this. And FCA, through its gritted teeth, said, oh, well, it's only really a secondary objective, isn't it? although they've now slightly perked up a bit and are being slightly less grumpy about it. The regulators, the FCA in particular, were absolutely emphatic. We're rather less interested in growth and international competitiveness than in consumer protection. And the third, and in my opinion, the biggest single Edinburgh reform, which hasn't actually been touted as such, is what I would call the general pushdown. And the general pushdown is at the moment, or rather, until Brexit happened, the actual effective date, a lot of the key rules were made by regulation, came out of the European system, and were automatically applicable. Market abuse regulation, market and financial instruments regulation, all the regulations, those are now going to be put into UK law. And the way it's going to be done is going to be pushed down to the regulator. Henceforth, if it wished, PRA, actually it would be FCA, could make market abuse rules, could make all the securities trading rules. And that is a really, really biggest change in the Edinburgh Reforms, which hasn't really been touted as a reform. Of course, it is empowering the regulators. Yes, it'll make regulation rather more flexible, rather more adaptable to the UK situation, but all practitioners have got to be massively vigilant. We could go asleep on MAR, we could go asleep on MIFIR, knowing it wouldn't change overnight. We can no longer really do that with the new arrangements. What it means, though, for absolute certainty, is that there can be no restoration of the single European passport. There can be no question of equivalence now between the United Kingdom and Europe, because our rules are going to diverge. The government says the package as a whole, Andrew Griffiths says it'll inject at least 100 billion into the economy, and that is simply from an adjustment to Solvency II, about which the PRA has said publicly it is very unhappy indeed. So it is, Edinburgh Reforms are a package of measures. It is really trying to seize the initiative on financial regulation. I think the biggest impact is going to be, it is now going to be the regulators will be making the rules. That would be my thought.
Thank you, Simon. I'm now going to turn to Hannah and ask her, if you had to pick one reform that's going to be a game changer for the industry, what would it be and why?
So I think this is a really tricky question to answer, because there are so many, as Simon just mentioned, 22 different reforms. And actually, I think the list is kind of growing as each of them kind of evolves into slightly kind of different areas. And they're all, to be honest, they're all quite important in their own right, but some of them are quite specialist to particular asset classes or particular sectors of the industry. And some of them are really more about the kind of, I guess, the underpinning, the plumbing of the regulatory system that is really supporting some of the more high profile initiatives, but without which those initiatives probably wouldn't actually work. But I think if I were kind of forced to, I guess, pick the ones that I think maybe are the kind of the real game changers, I think it would have to be the ones that relate to the future of the UK capital markets. So essentially those that are trying to incentivize companies to start and grow in the UK and to unlock capital from the private sector to support the growth of companies in the UK, because I guess these are the ones that could have the biggest impact for the country as a whole. And certainly the government thinks that they will help to create a more innovative economy for the future. And in terms of kind of giving you some examples of what those are, actually, I think there's a number of the reforms have elements that are really kind of focused on this. But I guess kind of in particular, we've got changes to the prospectus regime. So that's part of wider capital market reforms, including to the listing regime. But this prospectus regime reform is really intended to help companies to raise more money from investors more quickly, but in such a way that we're still ensuring that that investors are protected, but hopefully facilitating kind of wider involvement in the capital markets from a wider range of people, wider range of investors. Secondly, there's quite an interesting one, which is the introduction of a new type of trading venue called an intermittent trading venue. And the idea here is to help private companies to raise funds without having to do a listing or before they might get to the listing stage. And so it's trying to kind of bridge the gap between the private and the public markets. And then the third one, and maybe this is a bit of an example of a reform that kind of supports some of the others, but there are various reforms in relation to production and dissemination of research. So again, research kind of being seen as an important factor to helping investors become interested in companies, to know that they're getting the right information to make the investments, and to enable companies' shares to be priced appropriately. And so these reforms are all about trying to make sure that there is more research and better quality research in relation to a wider range of companies. So different sizes of companies, not just the biggest companies, and also particular sectors where perhaps there hasn't been so much research over the last few years. And also some of these reforms in relation to research are about simplifying some of the rules that we had put in place while we were in the EU. And I think that is also another kind of important factor here, is about a lot of these reforms are essentially kind of simplifying some of the rules, which I think is important more generally.
Thank you very much, Hannah. Over to Sarah. Sarah, have you or your clients started to see a change in approach from the regulators as a result of the Edinburgh Reforms?
Yeah, I think what we're seeing within the regulator is just a significant diversion of resources towards policy work, particularly in the FCA. So it isn't just the Edinburgh Reforms, large as they are. You know, you've also got the smarter regulatory framework overall that the FCA is trying to put together here, and that covers the future reg framework and the Mansion House reforms as well. So I think we're just starting to see the fruits of that policy work now. There was a sort of initial flurry, as you say, before Brexit went live, to make sure that we had an actual functioning regulatory regime, and now it's more about sort of the work that's been going on behind the scenes coming through, and actually starting to bear fruit in the sorts of changes that we're seeing in the context of the Edinburgh Reforms and others. And I think we're also seeing regulators face this kind of once in a generation task of reviewing the entire regulatory framework. And it's very much broadened out beyond just this retained EU law. So we're seeing a lot more resource within the regulators channeled into this. So you've got a regulator that's running, or regulators that are running BAU policy work on top of this huge task of reviewing the entire framework. And so those priorities are starting to come through now, and we are starting to see, particularly I think that secondary objective that Simon mentioned, come through in the way in which the FCA in particular is prioritising things like the wholesale market review and the Profexus reform that Hannah just mentioned. Things like the PRIPS review, which is probably the closest thing we've got to a real bonfire of regulation, in terms of actually going in a very different direction to the direction that the EU has taken, and trying to put together a bespoke UK regime, which is outcomes based and which hopefully will align more with the consumer duty. And I think actually PRIPS is a bit of a win-win for the FCA, because as Simon said at the outset, it's obviously very focused on consumer protection. We know the current PRIPS regime isn't really working well for consumers, but also it's a regime that doesn't work well for firms. So arguably it will make us more competitive if we can review that. So I think that's a particularly interesting bit of the reform. And I think moving forward, as we see retained EU law being pulled down into the handbook, there'll be a degree of kind of lift and shift in terms of these rules being reviewed, changed and consolidated with related guidance. And this is to Simon's point earlier around, we can't be asleep at the wheel now, because there is much more flux, I think, and movement within the framework of regulation in which we'll operate. And I think, it's from a sort of internal perspective for the regulators, I think this is such a big job that it will almost have a kind of drag, I think, on other aspects of what their overall work, because there is this massive policy burden on them now.
Yes, no, I see. Sarah, thank you very much for that. Rob, now thinking about the regulators' overall stance towards the industry, what has changed there for better and for worse?
Thanks, Vikram. So we're going to deal with a bit of that later on. But picking up on something that Sarah raised, I think there is a bit of a sense of a need to deregulate in certain areas, but then a sort of a lack of experience in the regulators with the deregulatory process. And so what you sort of tend to find is, so regulation tends to flow in one direction, as we all know, from less to more. And regulators are very comfortable with that. They're less comfortable with reducing regulation, and we saw a bit of that, I think, in the sort of bankers' bonuses scenario, where the announcement was made that the cap was going to be lifted. Then the regulators sort of said, well, we'll do some consultation around that, and then firms got themselves into a bit of a pickle because nobody quite knew what the timing was going to be, and everyone's annual bonuses were due to be paid, and we've seen a couple of our clients sort of get into a bit of a sticky situation in relation to all of that. A lot of that could have been very easily resolved by the regulator coming out and saying, look, it's gone. We don't need to consult for 3 months on removing it. It goes, and that's something which I think reflects a sort of a lack of experience in deregulation. So on Sarah's point, I think, you know, moving on the PRIPS example is a good one, I think, where, you know, you'd like to see the regulators, or the regulators, particularly the FCA, looking at that very carefully, but then deregulating it quite quickly, rather than giving a sort of long lead-in period as they sort of want to do when it comes to new regulation. The only other thing I was going to say here was that my sort of slight worry with it, and you know, the FCA and the PRA are full of very committed public servants who do a very difficult job on a very big and complicated industry. My sort of slight worry is that we end up with a slightly more parochial approach to regulation that looks very much inward to the UK and less outward to international fora than it did previously. And I suppose if I had 5 minutes with each of the CEO and the deputy governor of the FCA and the deputy governor of prudential regulation, I would probably say, look, just be a bit more fulsome about the way that you do international stuff and how it all fits together. Because my sort of worry of that is that if we move to a more parochial sort of regulatory environment, you just end up in a situation where the regulators are looking inward more than they're looking outward. And I think that has an implication for the industry, which we'll probably come on to talk about actually in due course.
Right. Thank you very much, Rob. I think we'll move on to the second topic, which is shooting first, asking questions later, the perils of earlier and earlier intervention. So, Rob, I think you're the first person I want to ask a question to. The question is, what are the panel seeing in terms of trends in early interventions from the FCA and PRA? And I'll first ask you, Rob.
Yeah, I mean, I can answer this in one sentence, but I will, and then I won't. Simply put, more and earlier is the short answer to that question. We're sort of routinely seeing clients now who are having their first contact with the regulator on a particular issue being the regulator wanting to intervene, and intervene hard and early, particularly where there's no supervisory contact or named supervisory contact for that firm.
Why do you think that is, Rob?
Well, it's interesting. I think it arises from 2 or 3 different things. The first is there has been a sort of regulatory ratchet on intervention over the years. The tough talk started in post-crisis, and it's sort of continued in that vein. There's also the overhang of all of these independent reports and reviews that the FCA and the PRA have been subject to, where there have been regulatory failure. So if you're a line supervisor in the FCA or the PRA and you have to take a judgment about what to do, one of the things that will niggle in the back of your head is, if somebody writes the report about this in 3 years' time, how is it going to look if I don't do anything? And so what that tends to lead to is a sort of slightly more keenness on the part of the regulators, if you like, or the supervisors, to reach for those supervisory tools early in the piece. I think you can add to that the overhang of the Treasury Select Committee, which is always looking and which occupies a huge amount of the regulators' time, particularly where you've got a significant issue that applies across the industry. So when you think about all of those things, it sort of is inevitable, I think, that the regulators become more interventionist. And I suppose if I put myself back in my old job, I think probably one of the risks of earlier intervention is that you kind of either overreact, so you go completely postal to one end of the spectrum and do something which is disproportionate, or you don't take time to prepare the case properly. And if you do that, you then don't think about the unintended consequences of what it is that you're doing, and the knock-on impacts for other areas of the firm's business or for other areas of the industry. Now, I would say this, wouldn't I? That was never the case when I was there, but it's an interesting kind of observation that what we see, certainly, and I'm sure others will say the same, is having to go back to the regulators quite regularly and say, actually, this particular thing that you're looking to do, have you really understood what the consequences of that are? And they don't always understand what the consequences of those interventions are. One other thing to say on it is, and I think there's an interesting parallel with the US here. The US has a very legalized form of intervention in the sense that there are lawyers everywhere in that process. I mean, literally everywhere in the supervisory process on a day-by-day basis. We've historically in the UK not had that. It's been very much the case that you don't bring your lawyers into the thing until it gets to a really difficult situation. And in fact, if you do it too early, it can look very defensive. I think if we start to see more and more intervention in a situation where the cases aren't well prepared, the stuff hasn't been thought through, there's a knock-on impact for the amount of challenge there's going to be to the regulators and the amount of time you're going to spend having to spend with lawyers in the room with the supervisors, talking them through stuff. And I think that will have a pretty significant knock-on impact going forward.
Thanks, Rob. Sarah, how are clients responding to that?
So it does vary. If you think about the way the FCA is running authorizations now, which is in another area where we're seeing much more kind of aggressive is maybe a slightly tough word, but we are seeing the FCA push firms harder, even at the very entry into the sector. And some firms have pushed back quite strongly on that, but ultimately they do still effectively have to dance to the FCA or the PRA's tune here to a certain degree. But what's interesting in that space is how hard the FCA is pushing policy objectives like the consumer duty, which I know we will get to later, both at the authorization stage and also in the context of change of control, which is almost kind of doing their supervision intervention by the back door in a way. But I think in terms of the day-to-day supervision, I'm going to agree vehemently with Rob here. I think the stakes now are actually a lot higher. And I think there are still some firms who maybe haven't quite grasped how quickly things can go south. And what might
Why did you say the stakes are higher?
Because I think people underestimate or maybe aren't as aware of just how wide-ranging these supervisory interventions are. I mean, they range right from requests for documents, ordering redress schemes, all the way to effectively cancelling a firm's permissions or limiting and restricting what they have regulatory permission to do within the UK in terms of financial services activity. They're very, very powerful tools. They're not. There's a different test at the tribunal. And the FCA has given itself, so it's more like a judicial review at the tribunal. The tribunal can't substitute its own decision like it can in an enforcement context when the FCA is looking to exercise a supervisory power and that's challenged by a firm. And the FCA has actually removed the RDC, which was a sort of an internal but separate committee of the FCA, which acted as a sort of, an intermediate step between settlement decision makers within the enforcement or supervisory team and then, your actual tribunal hearing. It's removed that from the process. So a lot of power has been centralized in the FCA itself, in its enforcement team and its supervisory team. And although I think my understanding is that the supervisory interventions will be run through enforcement. So a lot can happen very quickly and it can be quite significant for your organization. And actually, the FCA has, as I said, a lot of power here. So I think things that might have looked relatively benign can morph into something that is potentially much more serious quite quickly. And some firms, I think, are just better at others than reading the tea leaves. Quite often when we're doing enforcement work, we will get a handover of supervisory discussions and you review them. And it's quite obvious where this conversation was going. But maybe it hasn't been obvious to me as a lawyer, but it maybe hasn't been as obvious to the people, the supervisory contacts within the firm. So I think it is important to actually bring the lawyers in earlier. And I get asked that question, and I know it sounds somewhat self-serving, but I do think there is real value in getting that objective second opinion on what a regulator's real concerns might be and how to respond early and quickly in a way that actually inspires confidence within the regulator and staves off the possibility of these more aggressive supervisory interventions.
And actually, can I just add to that? So I completely agree with what Sarah's just said. I think there's something around with, and I know we all deal with this sort of work, there's something around being behind the curtain and when the law firm steps out from behind the curtain. And maximising the impact of that as part of the discussions with the regulators. And that's started to become something which for us is much more common. They sort of sit behind the firm for a while and help with that process, but at some point sort of come out from behind the curtain and say to the regulator, look, it's not the firm's just doing this by itself. It's actually got lawyers sitting behind it, helping it with the process. And that can make a pretty big difference to the outcome of the conversation if it's done right.
Right, very helpful. Hannah, question for you. Are there particular areas or sectors of the industry where the regulators are more interventionist? And if so, what might be driving that?
So, I mean, I think there are quite a few areas at the moment, but one that I thought I might kind of pick out because I think it's quite interesting is financial promotion. So the FCA has, over the last couple of years, put together a new team which is really focused on financial promotions and enforcement. And that team essentially proactively kind of looks at different marketing materials across all sorts of media, and also gets reports in from different sources. So that could be consumers, could be firms themselves, could be other regulators, and then reaches out to firms where it has concerns about the way in which they are marketing their products and services, and sometimes even actually suggests they should be doing things in a different way. And actually, this is one of the areas where there's quite a lot of statistics on the FCA website about the actions that they've actually taken. So if you look at what they've done in the first half of the year, the FCA says that it has, as a result of its interventions, about at least 3,700 financial promotions were amended or withdrawn, essentially following discussions and questions that they asked. And then, so I guess that's kind of at one stage in the process. The FCA has the ability to obviously to influence, but can actually require that firms change or remove adverts if they think that's appropriate. Can actually ban promotions in some cases. But they also have had 18 voluntary applications for requirements, so VRECs, which have restricted the ability of firms to communicate or approve financial promotions. So that's kind of like in the regulated sector. But the thing that I think is quite interesting is obviously there are some areas which are either not regulated or slightly less regulated. And financial promotion restrictions do apply to unauthorized firms or unauthorized companies as well. And one of the areas where I guess the regime has been expanded in the last few days is in relation to crypto. So the crypto companies that are not actually authorized at the moment because they don't need to be are now their marketing materials are within scope of the regime. And actually, in the first day, the FCA has already kind of published the fact that it has issued 146 alerts, basically putting companies that it doesn't think are complying with these new restrictions onto its warning list on the FCA website. And they have said quite openly to companies, not just in the UK, but overseas as well, that they plan to take further action if companies don't start complying with their rules in fairly quick order. And some of those interventions I think could be quite serious. I mean, there's a whole range of things that they're talking about, which includes, for example, making sure that essentially kind of incentivizing or making sure that social media platforms don't allow certain adverts to be made, but also potentially then going into enforcement action if they need to. And I think in terms of kind of like the drivers for all of this, I think there's a number of things, but I think consumer protection is really kind of high criteria here. And I guess it comes back to some of the things we were talking about earlier in terms of making sure that customers have the information they need to be able to make informed decisions about what they're buying and the protections that either go or don't go with those products.
Thank you very much, Hannah. Simon, what issues are panel members finding in terms of engaging with the regulators during the intervention process? And do you think we're going to see more formal legal challenge to regulatory decisions as a result?
It's difficult. I'll answer the second bit first. It's very difficult to mount a formal challenge to a regulatory decision because the only permitted route is to let it happen and to take it to the tribunal. And there are lots of different regulatory decisions. If it's a disciplinary case, you might wish, it tends more often to be individuals and firms, to take it to the tribunal. If it is a supervisory decision, such as an authorization or change in control or application refusal, you may not want to take it further because generally speaking, if the regulator has said in very strong terms, we think you're not fit and proper to do an acquisition or to take up such and such a position, very few people are determined enough actually to pursue that to the tribunal. And when it comes to something like a VREC or a VVOP, and that is where it is a voluntary request, and as we just heard, voluntary should be in italics with a couple of exclamation marks on either side. It is the FCA inviting you to apply on their terms, and then you have no right to challenge it because you've applied. But where you do have the FCA imposing a requirement, and a number of our clients recently, and I'm sure everyone else's clients, have received an order to stop business or an application that would result in them stopping business. Yes, you can challenge it, but by that time you're bust, because it tends not to be the big banks or the big fund managers or the big broker dealers that get it. It tends to be the small little firms, and they cannot really afford to accept a suspension or be subject to a suspension and to be challenging it 18 months hence in the tribunal, because that is as long as it takes you to get listed before the tribunal. And there is no challenge beyond the tribunal, as the FCA successfully determined 5 or 6 years ago in the Court of Appeal, when one High Court judge, I think it was Mr. Justice Silber, was bold enough to say, yes, I grant judicial review against the FCA on a disciplinary case, I think it was. And the Court of Appeal wagged its finger and said, dear laddie, they almost said, you must realise that judicial review is only when there is no other remedy. So no, I don't think we will see more legal challenges, simply because the system doesn't work like that. On the first half of the question of engaging with the regulators, it is the devil's job to engage with them. They would rather die than have a dialogue. The FCA in particular, the PRA to a lesser extent, it was much better under Rob's watch, may I add. The FCA likes having a dialogue.
You have to say that, don't you?
Yeah, he's kicking me under the table. The FCA prefers a written dialogue because it is more manageable. And if you do actually manage to engage with anyone, you've got to be utterly charming and you've got to charm them off their perch. But which, of course, I and any other lawyer would find desperately painful to do, to be charming, of course. If you want to succeed with the FCA, you have to show you're on their wavelength. If you start shouting, screaming, blustering, you're dead. You've got to show we're aligned, we recognise this is an issue, this is how we'll set about dealing with it. That, I think, can succeed. But it is very, very difficult to engage. And I've found the FCA legal department particularly reticent to have any kind of conversation on the grounds. And this is a real example. What they said was 3 or 4 wonderful things of A, we don't like speaking to the firm's lawyers because we think we're disclosing our case. Secondly, we're not going to give you arguments to use against us. Thirdly, we're not going to help you mount a challenge against us. Fourthly, and this was unusually candid, anything we say will be used against us in the tribunal, which is an interesting take on the without prejudice conversation. And so, I mean, that was from a senior FCA lawyer in General Counsel's department. That, in my opinion, is disgraceful conduct. But what it does say is, rather like the silly street directions, if I were you, I wouldn't start from here. Never allow a client to get in a position when they're having a fight of this nature with the FCA, because to use, I think it could have been Hannah's comment earlier, they didn't read the tea leaves properly. It is so important to read the tea leaves and avoid the situation. Very difficult to get you out of it.
Thank you very much, Simon. Does anyone else have any comments on that particular point about the engagement of the regulators at the moment? Has anyone got any experiences they want to share, or do you think that Simon's covered it?
Just to amplify Simon's point, I think it's absolutely right that
about it better when you were in charge. You mean?
That's exactly the point I was going to make. Thanks. No, so really what I was going to say was just amplifying Simon's point about the dialogue, where you can get it being a constructive dialogue and taking account of what the regulators' objectives are. Because certainly where I've found it to be successful is where you manage to get hold of somebody and then you talk in a sort of grown-up way about everyone's objectives and try and reach a conclusion. The scorched earth process generally does not work, as Simon said. It just doesn't. It's not set up to be fruitful, if I can put it that way. Okay,
thank you very much. I'll move on, I think, to topic 3, which is it's all about duty, early learnings from the consumer duty post-implementation period. And I think I'll turn first to Hannah. Hannah, the consumer duty came into effect across the industry from July 2023. What are you seeing in terms of immediate post-implementation challenges for clients?
Maybe I'd just start with a quick attempted quick explanation of what the consumer duty is, because maybe it's helpful background. This discussion about whether there should be some kind of duty of care in financial services has been going on for a while, and the FCA in particular had identified a number of concerns where firms were potentially exploiting consumers' biases, their loyalty or inertia, situations where products and services were maybe not fit for purpose or didn't represent fair value, and firms were not providing as good consumer support as they should be. And so basically all of this, and Parliament also looking at this, has kind of led to the introduction of this consumer duty, which is essentially a new principle, so an extra principle for business in the FCA rulebook, which is that a firm must act to deliver good outcomes for retail customers. So that's the kind of the underlying principle, and we have a number of more detailed requirements around that, but in particular 4 outcomes that are really what it's kind of all about in terms of what firms have been focusing on. So that's to do with products and services outcome, price and value outcome, consumer understanding outcome, and a consumer support outcome. So in answer to your question, in terms of kind of immediate kind of post-implementation challenges, I guess what some of the things that we've been seeing are, although the duty has now come in and most firms have been working on it for a long time to be ready for implementation, in some ways we're really kind of at the start of the journey, because this is an ongoing obligation, and obviously things need to kind of develop further. There's actually another set of products, so the products that are kind of closed products that are no longer available for sale. The duty will come into effect for those next year, but even beyond that, this is essentially now part of the regime. We have to think about consumer duty in everything that firms do. So say really kind of we're only at the starting line. But in terms of kind of what we're seeing at the moment, I guess a few things. First of all, kind of for the implementation plans that firms have already had, it's kind of finishing off some of that implementation where it just wasn't possible to do that already. Secondly, kind of optimization and refinement of some of the systems and controls that firms have put in place. So now that they're actually putting this in practice, kind of realizing what works, what maybe doesn't work so well, kind of adjusting those to make them kind of work better for the future, and putting some of that practical learning into operation. I guess thirdly, maybe assurance and benchmarking. So kind of really looking at whether what firms have done is good enough by reference to, have they implemented all aspects of the duty, and how does what they've done compared to what others have done, and obviously that kind of becomes clearer as the duty is now in place. And then I guess also kind of preparing for the next steps. So for example, there's an annual compliance assessment and board report that needs to happen, and in order to be able to put that together, you need to have gathered the right types of information about how the duty is working in practice, and so really making sure that all of that information is available to be able to do that in due course.
All right, thank you very much for that, Hannah. Simon, how would you say the consumer duty has changed the FCA's approach to supervision, if at all?
It hasn't yet, because the consumer duty has only just come in, but it will definitely change. I don't know about the approach to supervision. I would probably say the likely outcome of supervision, because the FCA is jacking up the standard. And one particular aspect of the standard that is particularly concerning is this. The consumer duty has got 4, as Hannah has just explained, has got 4 outcomes. One of them, for example, that products are made with customers in mind, has sort of been around for quite a while when you've got to have product governance that's thought carefully about the products. But one in particular has got a sting in its tail. In fact, it's all bite, never mind just the tail, which is value for money. Firms should seek to ensure that products offer value for money, and that is not massively well defined. And there'll be some products which are quite clear. If, for example, I sell you mobile phone insurance, and the most common cause of loss of mobile phone is theft, and I make the theft while unattended, and I have in small print, theft while unattended is not covered, then you're spending a lot of money on something which isn't going to deliver value, particularly when it's what's called a rider product. In other words, you're all excited about getting your new Samsung triple foldable Galaxy, and the shop assistant, who is probably on 50% commission, will say, "Oh, Mr. Sakdeva, oh, you're a KC, you must be interested in legal matters. Well, let me sell you this. Would you like protection so no nasty barrister's clerk steals your phone when you're not looking?" And you say, "Yes, yes, I'll buy it." Of course, the whole point is it doesn't offer you value for money. And
would it be enforceable, though, under the red hand doctrine if it was buried?
Well, possibly not, but most customers will just throw up their hands and go away and not pursue it, I'm afraid. But I think the point is, all too often firms don't focus on that, and I think that will be an area of focus for the FCA in particular.
Right. Thank you very much, Simon. Sarah, what about the likelihood of further intervention? Do you think we're going to see the FCA enforcing more?
So, I mean, just to pick up on something Simon said, we're already seeing the FCA intervene around value. We saw the FCA requesting value for money assessments for cash savings account for some of the 9 biggest players in the market earlier in the summer, and we're due to get some reporting back on that. And it was interesting that that request wasn't just for new and existing products, it was also covering closed accounts as well, which haven't been through the implementation process yet. And I think it's an early example of how the FCA is going to use this new toy, which it has to play with whenever there is a scenario where customers are perceived as, or indeed are actually suffering harm. The consumer duty gives the FCA significantly more scope to bring enforcement action and supervisory interventions against firms. So if you step back and think, why have we got the consumer duty? One of the reasons, other than Parliament saying we had to, was this feeling that the pre-existing consumer protection regime that we had, so treating customers fairly, or TCF, hadn't worked. So customers were still suffering harm, and that something more than that was needed. But one of the reasons I think that is perceived as having failed is that it was quite difficult to enforce against. An awful lot of that regime was in the form of guidance, which is harder for the regulator to get home on in terms of interventions and enforcement. And what the FCA has done cleverly in constructing the duty is it's given an awful lot of that guidance the status of rules, which is a game changer from an enforcement perspective. And also the nature of those rules is particularly helpful in an enforcement context. So if you look at the duty, it's sort of pyramid shaped. So you have the new principle 12 at the top, and then you have those 4 outcomes that we've talked about at the bottom, and sitting in between them, you have the 3 cross-cutting rules. And one of those is the obligation on firms to avoid causing foreseeable harm. Now, in comments after her first speech as co-director of enforcement, Therese Chambers, the FCA, said that she was fond of that particular cross-cutting rule. And you have to ask yourself why, as an enforcement lawyer, she's particularly fond of that one. And I think it's because it's something of an easy win for the FCA if consumer harm was eventuated. Was that harm foreseeable, and did you firm cause it? And I think if firms don't have a very good, well-documented story to tell about what harm they have considered may eventuate from a product that they are putting out to market on a product by product level, both what was considered at the point of construction or inception of the product, and then also on regular subsequent reviews, and the steps that they took to mitigate that harm, it's going to be really hard to argue that whatever has subsequently gone wrong wasn't also foreseeable. You just missed it as a firm. So I think there's this kind of like an open goal there for the FCA if firms aren't careful. And I think, given the FCA's focus on preventing and limiting harm, I think it will actually be a while before we see any concluded enforcement action. It takes a long time. And also I think, those supervisory interventions that we've already talked about are actually much more attractive in this context because they're quicker, they get redress or, redress potentially out to customers much more quickly, or they just stop something happening, in quite short order, all of which is obviously beneficial to consumers. So I think it will be a while before any actual sort of enforcement cases come through. But I think the FCA is probably going to want to scalp, and it will use its enforcement, the enforcement process to send a message to the industry about its expectations here. So I think when that happens, it will be quite a significant event.
Right, thank you very much, Sarah. Moving on to the fourth and final topic. Do send through any questions if you have any, using the Q&A at the bottom. So the fourth topic is crisis to containment. What does 2023 tell us about future regulatory interventions? And Sarah, sticking with you, 2023 has been something of a year of crises for the regulators, starting with FCA interventions in relation to the cost of living crisis. Does this, you think, reflect a change in approach from the FCA?
So I think this actually almost brings this discussion full circle, because I think what's going on here actually echoes some of the points Simon made right at the outset, in that we have a regulator who is perpetually reacting to external events and, to an extent, political pressure. And I think, to be fair, arguably, we also have a government which tends to position every financial problem as the FCA or the PRA's responsibility to fix. And I think, if you look at the past decade, as Simon said earlier, every time there's been a crisis, and you can use that term reasonably loosely here, so any kind of sort of mismanagement or poor behaviours by firms, we've often seen the FCA hauled over the coals for either failing to prevent it or having to defend its position before the Treasury Select Committee and others. And if you add into that the massive internal reorganisation that the FCA in particular has recently been through, which has led to an awful lot of senior and experienced staff leaving, and some teams under strength, and that diversion of resource towards policy that we also talked about at the start, you're left with a regulator who is quite defensive, quite reactive, and what you would ideally want is a calm, confident regulator who has a clear plan and a sense of their own purpose and their role. And that, that filters through in actually so many of the things we've talked about today. And so that inability to engage in a kind of sensible way with the regulator, that sort of shoot first and ask questions later approach around potentially supervisory interventions, it's taking that path of least resistance and least risk, because it's probably potentially the most defensible, and not learning those lessons when things go wrong. So the FCA has had its knuckles wrapped at the upper tribunal in an enforcement context around things like limitation, how it prepares its case, documents, and disclosure obligations quite a few times, and the same points keep being made, and they don't seem to be kind of learning the lessons from that. And so I think what we've seen this year in respect of the interventions and the action that we have seen around the cost of living crisis and things like the cash savings account issues when interest rates were going up, it is more of the same in a way, except that actually the FCA has this new tool, as I said, that they can use in the terms of the consumer duty, and it can ask for those value assessments. And so far, that looks like it's been a good news story for the FCA, because the number of savings accounts with higher rates has increased. But you're still seeing that same sort of pattern of the FCA reacting and then kind of positing a policy, in this case the consumer duty, as being the thing that will solve all the problems, which of course it won't necessarily. So I think there is a sort of a cultural issue there, if you like, which I think the way in which it's responding is potentially maybe doing slightly more harm than good.
All right, thank you very much. Rob, turning to bank failures, what can we learn from the issues around SVB and Credit Suisse?
Two things, I think. The first is we still haven't found a way, despite all the thinking that was being done around the time that the PRA was established, we haven't determined a way to read the tea leaves and figure out where the next banking crisis is coming from. So it's kind of axiomatic in the regulatory system that every response to a crisis deals with the previous crisis, not the next one. And if you think about the SVB situation, that's a pretty good example of that. So what do? Post the crisis, you say, no more casinos, let's put all your capital into low risk instruments like gilts, which works beautifully when you've got no interest rate issues. But as soon as you get into an inflationary environment and the gilts are not good value, you can't sell them. When do you need to sell them? When you have issues around your parent company potentially going bust. You can't sell them. You have a liquidity run because everybody wants to withdraw their money, and it's not just consumers like Northern Rock queuing around the block. It's now big companies who've got tens of millions of pounds sitting in there. So the amount of liquidity you have then goes down very rapidly, and suddenly you're in a very sticky situation. That is not a direct result of the previous crisis, but it's an unfortunate impact of pushing firms to invest in certain forms of asset for their capital adequacy. The second thing is around business models, and I think this is really interesting. So regulators are really interested in business models, and they look very carefully at them, but they don't always look at them through the right end of the telescope. And SVB is a good example of that. So the PRA is always very worried about what it calls concentration risk, which is the exposure concentration that a firm has, i.e. who is it exposed to in its counterparties, and is it exposed in too great a measure to one particular counterparty? But never in the history of the PRA's existence did it look at the question of, is a firm exposed to concentration in its customer base? And in SVB, what you had was a customer base that was highly technologically focused, fintech focused. And as a result of that, when there was a risk of the bank going under, there would have been a hugely disproportionate impact on one sector of the economy, i.e. the fintech sector. And that led to the government effectively coming in at the background and saying, look, come on, we need to sort this out. We can't just let this thing go to the wall into the insolvency process. Hence, it gets sold to HSBC for £1. So in that situation, what you have is a series of situations where the PRA rather is not looking necessarily at the right things at the right end of the telescope, because it's still focused on avoiding the last crisis. We can't have another crisis like the last one, and moving it from that backwards to forwards-looking thing has been successive deputy governors have tried to do that, and it's getting better at it, but it's still got a bit of a blind spot. What does that mean for the future? Well, I think the idea of letting a bank go to the wall through an insolvency process just seems slightly more remote than it did a year ago. We know the political pressure is there from the government again, and Sarah and Simon have talked about this political pressure thing as impacting on the regulators in a fairly significant way. We know
that's a good thing, though.
Well, it is a good thing in the sense that it forces an outcome. But it's not a good thing if you're sitting inside the Bank of England saying we've got these policies that we want to pursue, and our policy approach is to allow anything other than a major bank to go into an insolvency process, because then the government comes in from the side and sort of potentially takes your knees out in that context. So in that sense, you sort of think that actually these sorts of conversations behind the scenes will continue. The bank did a very good job of painting the SVB thing as an amazing outcome for everybody, and it probably was actually when you think about the downside risk of it. But I'm not entirely sure it was an amazing outcome because they'd spotted it miles in advance. I think it was more an amazing outcome because a load of people worked very hard over the weekend to make it such. And so sort of faced with that, you kind of wonder whether actually in another analogous situation, finding a purchaser, even if they only pay £1 for the bank, is preferable to letting it go into the insolvency process, which will take yonks and yonks to work its way through. So there's some sort of interesting lessons there for the future in terms of how the regulators will look at this question of bank failure.
Thank you, Rob. Simon, what about recent issues about debanking of both ordinary people and extremely important people from exclusive banks, and also PEPs?
You weren't debanked, were you?
No, I'm far too important to be debanked.
Of course. Okay, well, if we're talking about concentration risk with customers, what about COOTs? They're overexposed to TOFs. Now, PEPs and debanking are absolutely two different topics. Beginning with PEPs, you're damned if you do and you're damned if you don't with PEPs. On the one hand, the regulators are berating you all the time. The European Banking Authority has criticized all the regulators for their reaction to Luanda leaks. The FCA put out a paper last year on financial crime controls at challenger banks, saying they weren't good enough. The FCA publishes disciplinary cases over PEPs and berates small banks for not dealing with their PEPs. So you're damned if you do, and you're also damned if you don't, because there's now a greater focus on debanking, the risk of financial exclusion, and the fairly obvious point that a lot of debanking is avoiding rather than managing risk. In other words, I am dealing with people in such and such a jurisdiction. It's more than it's worth. I'm going to debank them. So I'm not managing the risk. I'm avoiding the risk. And that is PEPs. And by complete coincidence, the FCA is doing a PEP review because the statute, the 2023 statute, amazingly said within 12 months, FCA must review its PEP guidance. So it's complete coincidence it is happening at a time of some concern over debanking. But PEPs and debanking are completely different issues. PEPs are to do with politically exposed persons, which really means members of parliament, utterly senior officers in the armed forces, utterly senior civil servants, correspondingly important people overseas. I've heard it suggested local councillors are PEPs. Don't make me laugh. They're simply not. And there is a review going on, and there's quite a lot of sensitivity over it because of debanking. Now, the FCA and PRA are really jittery over debanking. Have a look at their recent papers on diversity and inclusion. They both see fit to say, we think that diversity and inclusion policies should not result in debanking. We think that this has got nothing to do with it, which is quite surprising. What is happening with reputational debanking is this is a completely separate issue. And there is someone, Nigel Farage, by the way, was not, I believe, ever a PEP. He certainly isn't now. And the Treasury Committee, this is how they lacerate the FCA, how I weep for them. The Tory MP, Mr. Kruger, I keep on to one Jimmy Kruger, but I don't think he is.
Danny Kruger.
Danny Kruger. I'm obliged. He's really good. And he was asking Ashley Auld, the chair of the FCA, are there any legal or regulatory requirements why Coutts debanked Mr. Farage? No, he said through gritted teeth, not that I'm aware of. And it continued. Is it right that someone should be debanked for their political views and activities? Ashley Auld, it's fundamentally up to a bank to choose who to do business with, completely mealy-mouthed. Now, that is currently...
Is that mealy-mouthed, though? Is it not a contract? Can you not choose who to contract with? And on the other hand, why should banks disapprove of particular political views?
Well, quite. And the point is, the government is now on that, saying people should not be debanked. Now, if Coutts debanked someone because they were black, or because they were gay, or because they were transsexual, that would be an absolute outrage.
Well, they won Eurovision, for instance. I mean, that might be a justified reason to debank them. But anyway.
I think that would be justified. It's in Schedule 1 to the statute. There's reasonable discrimination. But it is thought that this is a challenge to free speech. And you've got examples like the clergyman in Yorkshire who was allegedly debanked by Yorkshire Building Society because he was asked to comment, what did he think? And he said, well, I don't actually approve of your supporting LGBT rights. It is thought, given that banking is, in this country, it's not a right. In some European countries, you are entitled to open a bank account. But given it is fundamental, and if you're debanked, you become an Orwellian unperson, you cannot do anything. I think the government is probably right to have a look at this. But debanking and PEPs are really two issues. They do definitely need to be decoupled.
Thank you very much, Simon. Hannah, over to you. Thinking about the fintech sector, what challenges are the regulators having to grapple with there?
So I think one of the kind of key things here is that there are pretty high expectations from a whole spectrum of different views in relation to fintech, and I think crypto is a particularly good example of this. You know, where you've got some people, and this is both, you know, general public, but also people in government and probably people in the regulators as well, who think crypto should be banned. And then on the other kind of extreme, you've got people saying, well, actually, UK should be open for crypto business. We should be leading the fintech revolution. And I think you've got kind of everything in between those quite, you know, different ends of the spectrum. And I think having to find a way of, it comes back to the point about there's a big expectation on the regulators to make this work in whichever way basically avoids scandals, avoids consumer detriment, and ensures that we are competitive with the rest of the world in relation to use of new technology and putting it to good advantage. And I think there's some really difficult balances to make there. And I think kind of regulators essentially having to kind of look in so many different directions, and the wind is kind of often changing here. So when there's the latest failure or the latest scandal, then that obviously kind of impacts on the way these views are held. But I think in terms of kind of the going forward, what appears to be the plan in terms of extending the scope of regulation to include various crypto activities, there's obviously that's quite a difficult job in terms of making the regulation work for these activities, which in some ways have parallels to traditional financial services, but actually in many ways are quite different. And in order to regulate them in a sensible way, you are going to have to kind of work out how to adjust the rules. And actually, I think the regulators in the UK have put a huge amount of effort into really understanding how some of these technologies and products and services work. But now trying to kind of make a set of rules that is going to work in relation to a fairly diverse range of things, I think is going to be quite technically challenging. And then I think the other kind of area of expectation is actually kind of going through the authorization process for some of these firms. It's kind of really those expectations about what the regulators are going to expect in terms of meeting their standards. We've had some, I guess, experience of this with the AML registration process, where the FCA was quite open about the fact that actually a number of companies weren't really meeting the expectations that they needed in order to comply with the rules. And so there will need to be a process where, you know, that kind of works, where people are clear about what the expectations are for the authorizations themselves. So I think there is quite a lot that's going to have to play out in the next year or so as this process evolves.
Right, thank you very much, Hannah. I note that there aren't actually any questions yet, and we are in fact also out of time. So I'd very much like to thank Sarah, Hannah, Simon and Rob for a most illuminating webinar, and I wish everyone a very good evening. Good evening.